Good day. Today we are doing income taxes, and that you can find in IAS 12. But in terms for FRK 201, we will only look at how to calculate current tax, the movement between the movement of deferred taxation, and the provisional payments that will be over or under over provision. We are in later in the slides or later in the video you will hear what it is. So in terms of FRK 201, we will look at the current tax, how we calculate it, the movement of deferred tax, and the over or under payment of current tax. Then income tax. What is income tax? Then it tells us income tax is levied on all income and profit received by a taxpayer, which includes individuals, companies, and trusts. It is the national government's main source of income and is imposed by the Income Tax Act number. Then they tell you it's levied on all income for individuals and companies, and it's the government's main source of income. Then how does income tax affect accounting? The payment to SARS is an outflow of resources, and we look at the presentation and the disclosure thereof. Remember, when you pay SARS an amount of tax, it is an outflow of your resources because you're paying SARS. And then the presentation. The income tax line item appears after profit before tax in the statements of profit and loss and other comprehensive income. As you can see, the income tax expense is subtracted off profit before tax to get your profit for the year. And now the question is, what does this income tax expense line item exist out of? And here you can see it exists out of your current tax, your over or under provision, and your deferred tax. As I told you in FRK 201, we look at these three things, and we will look at them individually now. And in your statements of financial position, in your assets, under non-current assets, you see deferred tax assets, and in your current assets is the current tax assets. In your liabilities, it's the deferred tax liabilities, and in under current liabilities, it's the current tax payable. Just a note on that, companies can have both of these or can have all of them. They can have a deferred tax liability and a current tax payable or a current tax receivable. And then we are looking now at current tax. What is current tax? As I've told you, the tax and the accounting is not always the same, and that means your taxable income is in terms of your taxation, is in terms of tax, the BAL subject that you have, and that means your taxable income you multiply by the tax rate to get your current tax. And current tax in terms of FRK is your cash flow, because the current tax is what you're going to pay to SARS. It's what you owe to SARS that you've calculated based on your taxable income. That means it is an outflow of resources that went out of your bank. That means the current tax payment that you make will appear, you will use that amount in your cash flow statement. And then what is taxable income? Taxable income is you start with your profit before tax in accounting, then you add back non-deductible expenses. It is, for example, fines that you have paid for SARS or speeding fines, and then you deduct deductible allowances. That is, for example, Article 12C, the wear and tear allowances that SARS gives you. And then you deduct non-taxable income. Non-taxable income is, for example, dividends. And then for FRK 201, we will give you the amount and the tax rate. You must just know what to do with it. So, for example, we will give you the profit before tax, and then you will tell you that you have, and for accounting you have written off depreciation of a certain amount, but tax allows a wear and tear of a certain amount. That means you need to add back your depreciation and deduct the deductible allowances, and the deductible allowance in this case will be wear and tear. And then we will give you the tax rate, and you must just know what to do with it. If we look at an example of how to calculate current tax, a company A has an accounting profit before tax of 250,000. Included in this amount is dividend income from a South African companies, speeding fines, depreciation, wear and tear allowances, and we give you the tax rate is 28%. Then we say calculate taxable profit and current tax. The taxable profit is the taxable income. Then, as I've told you, you first start with the accounting profit of 250, then you deduct the non-taxable income, and in this case it is dividend, so you deduct the 12,000 Rand. Then you add back the speeding fines because it is a non-deductible deduction. Then you add back the depreciation because it is also a non-deductible expense, but you subtract the wear and tear allowances because that is the amount that SARS allows you to deduct from your profit or from your income, and that gives you a taxable profit of 200,000, 36 Rand and 250 Rand. Then you multiply this amount by 28%, the rate that we gave you. We will always give you that rate, and you get a current tax of 66,150. That means you are going to pay this amount to SARS, and it will be an outflow of resources. And then just the journal entry for you guys to see it. You will debit income tax expense, that is a profit or loss item, with that amount, and you will credit the current tax payable or SARS, that is an SFP amount, for with that amount. And then when you pay it, you will debit the current tax payable and you will credit your bank. So can you see the current tax is the bank amount, and that is the amount that you will use in your cash flow statement. And then the second point I've told you that we do in accounting is the movement in deferred tax, but you first need to know what is deferred tax. A deferred tax arises because we receive deductions for accounting purposes that we receive for tax purposes only in the future, or we get the tax deductions now that we only receive later for accounting purposes. Therefore, tax is deferred. For example, if you look at depreciation, for accounting, you depreciate more than for tax, so there is a difference. For tax, you will get it later on, where for accounting, you get it now. So there is a difference in the accounting treatment and the tax treatment. Therefore, that tax is deferred, and therefore, we have deferred tax. And then, what is a deferred tax liability? You will have to pay more tax in the future, and the deferred tax asset is you will receive a tax deduction in the future. This means if you have a deferred tax liability, the beginning balance will be on the credit side as it is a liability, and a deferred tax asset will have a debit balance as it is an asset. And then I've told you we only do the movement for FRK 201. And what is the movement? The movement is the movement between the opening balance and the closing balance. If we look, for example, I tell you that you have an opening balance for deferred tax liability of 85,000 Rand, and now you have a closing balance of 92,000 Rand. And remember that closing balance, we told you it's a deferred tax liability, and therefore there's a movement of 7,000 Rand between the opening balance and the closing balance. that is an increase of 7,000 Rand. And that's why when you do the journal entry for the movement, it is debit income tax expense and credit your deferred tax with 7,000. Remember, as I've told you, the income tax expense line item in your profit or loss statement exists out of your current tax, your deferred tax movement that we do, and the under or over provision of payments. And then another example. If it is a deferred tax asset, we tell you, for example, the opening balance is now 92,000 on your debit side because it is an asset, therefore it has a debit balance. And the closing balance is 85,000 Rand. Therefore you have a movement of 7,000 Rand. That is an increase. Therefore you debit the deferred tax and you credit the income tax expense. Remember, the movement of 7,000 Rand is the movement in the deferred tax T account. So we told you it is an increase, and the increase is on the debit side. Therefore, you debit the deferred tax, and the credit side will be income tax expense. Then the third thing that we do is provisional payments, where you will calculate based on that if you have an over or under provision. What is a provisional payment? In terms of SARS, you must make 3 provisional payments for SARS. The first one is 6 months after the start of the financial year. The second one is at the reporting date, and the third payment is 6 months after year end. For example, if your financial year is from 1st January to 31st of December, you will have the first payment will be in June, the second payment will be at your reporting date, and the third payment will be 6 months after year end. And as we've told you, with the first and the second payment, an estimate of the taxable income must be made. And with the third payment, a payment is made to settle the outstanding liability. This will become more clear for you when we do an example. And just a timeline for you, we say the first 6 months money goes out, the next 6 months also money goes out at year end, and after year end 6 months we also pay money. And the journal entry will be you pay your current tax, you pay SARS, you debit current tax, and you credit your bank because there's an outflow of resources. And then what is an over or under provision? If we pay too much, we get a tax refund. Therefore, we overestimated. And if we pay too little, we pay more. Therefore, there was an under provision. If we look at an example, we look at the same example as we did in current tax. Because remember, your provisional payments is based on your taxable income estimates, and taxable income is the amount that you will times the multiplied by the percentage, the tax rate percentage. It is your tax that is payable to SARS, therefore it is your current tax. If we look again, we see the answer is still the same, that your current tax is 66,150 Rand. When we look in under provision for an example, your first payment is also based on an estimate. Therefore, at the beginning or at June, if your financial year is from 1st of Jan to 31st of December, you make an estimate in June that your taxable income at year end will be 190,000. Then you divide it by 2. Why? Because you need to make 2 payments. Remember, the first payment is 6 months after your financial year starts, and then the other 6 months later at year end you pay the other amount, and the third payment is only to pay the outstanding liability. We will get to that later. So that's why you divide your taxable income by 2. And you multiply by 28% the tax rate. Therefore, you get a current tax that is payable of 26,600 Rand. Then, therefore, you pay it. Then, your estimate, remember your second payment is also an estimate, even though it is based on the accounting profit. SARS can have different rules or may have a different amount that they say is your taxable income. Therefore, your taxable income at year end is also an estimate, even though it's based on the accounting profit, because the accounting profit that you use for your taxable income, where you deduct or add back, can have different rules, or SARS can calculate the taxable income differently. So therefore, your second payment is also an estimate. And then remember, we told you the current tax payable is 66,150 Rand. But remember, you already paid 26,600 Rand. Therefore, your second payment is only 39,550. And then you pay the total amount, as we've said, of 66,150. And now let's, for example, say that SARS comes back to you and says, no, we calculate that you owe us 69,000 Rand. They've calculated and you owe them 69,000 Rand. You paid SARS only 66,150 Rand, but SARS says you owe them 69,000 Rand. Was it over or under provision? You have an under provision because you paid too little with an amount of 2,850 Rand. That 2,850 Rand is the additional payment required. That is your payment 3. That is to settle any outstanding liability. And if we look at your journals for your under provision, you will debit income tax expense with 2,850, and you will credit your current taxes 2,850 because you paid too little, so you need to increase what you need to pay to SARS, or credit bank if you pay it immediately. But if you do not pay it immediately, you need to take it first to current tax. And just the T account so that you can see. And then if we do an over provision, the same example, but we tell you the amount according to the tax assessment is only 65,000 Rand. Can you see that you've paid 66,150 to SARS, but SARS says you only owe them 65,000 Rand. That means you paid too much, therefore you made an over provision. Therefore, SARS needs to refund you with 1,150 Rand. And if we look at the journals, you will debit your bank or your current tax, because bank you will get money in, or your current tax you need to decrease it. And you will credit your income tax expense with that amount. And then just your T account. And then the disclosure, remember we did the presentation. The presentation is in the statement of profit or loss and other comprehensive income. And the disclosure in the notes will look like this. Notes for the year ended. And then your heading is income tax expense. And then the major components of tax expense is your current tax, your under or over provision in terms of the previous year, or your deferred and your deferred tax. Remember, your deferred tax is just the movement. And that gives you a total that will come into your components of major tax expense. And just on that note, the under or over provision in terms of the previous year, remember you estimate what will be your taxable income. And that's why it's only an estimate, and that's why you make it correct in the next year and you don't reopen your previous year. That's why it says under or over provision in terms of the previous year, because you pay it 6 months after year end. So it is in the first 6 months of your next financial year. And we are done.